Welcome to the Deep Dive. Today we're getting into something called investment property, specifically how it's defined under IAS 40.
That's right. It sounds technical, maybe, but it's really about how businesses account for property they hold to make money, not for their own day-to-day use.
Exactly. Think rentals, or just holding land hoping it goes up in value. And understanding this isn't just for the accounting pros, It gives you real insight into a company's strategy and financial health.
IAS 40 basically gives us the rules of the game, how to recognize these properties, how to measure them financially, and what needs to be disclosed in the reports.
And importantly, what's not covered.
Yeah, definitely. It carves out things like biological assets, think forests or mineral rights. And crucially, it doesn't cover property the company uses itself.
Owner-occupied property. That falls under different standards, like IAS 16 for owned assets or IFRS 16 for leases.
Precisely. So IAS 40 is really focused.
Okay, so let's nail down that core definition. What is investment property according to IAS 40?
It's pretty clear, actually. It's land or a building or even just part of a building that's held to earn rent or for capital appreciation, meaning its value going up. Or, both.
The key thing seems to be the reason for holding it.
Absolutely. It's all about the intent. Is it held to generate investment returns, kind of separate from the company's main business? That's what makes it different from owner-occupied property.
And it generates its own cash flows, largely independently.
That's the idea. The rental income or the potential resale value is distinct from the cash flows of the widgets the company makes, for example.
Right. Can you give us a couple of quick examples? Make it concrete.
Sure. Maybe a company buys a plot of land purely speculating that the area will develop and the land value will shoot up. That's investment property.
Okay.
Or a more common one, a company owns an office building and leases out all the floors to other businesses under operating leases. Classic investment property.
What about property being built?
If it's being constructed or developed specifically to be used as investment property in the future, yes, that counts too, once it meets the criteria.
Right. So what's definitely not investment property then? Give us the flip side.
Okay, well, property held for sale in the ordinary course of business. Think a house builder. Those houses are inventory, not investment property.
Make sense? Different purpose entirely.
Exactly. Also, owner-occupied property, obviously. That includes property the company plans to use itself later, or maybe housing provided to employees.
What about property leased out under a finance lease? You mentioned operating leases earlier.
Good point. Under a finance lease, the lessor essentially transfers most of the risks and rewards of ownership to the lessee. So from the lessor's perspective, it's treated more like a disposal or financing arrangement, not like holding an investment property for rental.
Interesting distinction. Okay, what if it's a mix? Say, a building where the company uses a couple of floors and rents out the rest.
The mixed-use scenario. Well, the standard says if the different portions, the owner-occupied part and the rented-out part, could be sold or leased out separately.
Like individual floors in an office tower.
Yeah, exactly. Then you account for them separately. The rented part is investment property. The used part is owner-occupied under IAS 16 or IFRS 16.
Well, what if you can't easily split them? Like it's just one integrated building.
Then it comes down to significance. If the part the company uses itself is really minor, sort of insignificant, then the whole property can still qualify as investment property.
And if the owner-occupied part is significant?
Then the whole property is generally treated as owner-occupied. It can't be investment property.
It requires a judgment call then.
It does. And linked to that is the issue of services provided. If a company rents out an office building but also provides, say, basic security and maintenance.
Per standard stuff.
Right. If those services are relatively insignificant to the whole arrangement, it remains investment property.
Right.
But if the services are significant, think of a hotel.
Oh, yeah. Lots of services there. Cleaning, reception, room service.
Exactly. The owner is actively managing and providing significant services. That usually makes it owner-occupied property, not investment property, because it's more like running a business from the property.
So it's not just passively collecting rent.
Correct. Companies need to use judgment here, and IAS 40 requires them to disclose the criteria they use when classification is difficult.
Okay, that clarifies the what's. Let's switch gears to the accounting itself. How are these measured after you first recognize them?
Right. After the initial recognition at cost, a company has a choice. It has to pick one policy for all its investment properties, either the fair value model or the cost model.
a consistent choice across the board. Let's take the fair value model first. What's that involve?
Under the fair value model, the investment property is remeasured to its fair value, basically its current market value at each reporting date.
And the changes in value.
This is key. Any gain or loss from that remeasurement goes directly into the profit or loss statement for the period.
Wow, okay. So that could make profits quite volatile depending on the property market.
It certainly can. It provides a very current market-based view of the property's value and performance, which many argue is more relevant for investment assets. Investors can see the impact of market movements immediately.
All right. And the alternative, the cost model.
The cost model is more traditional, maybe. It follows the approach used for owner-occupied property under IAS 16. You measure it at its original cost, less accumulated depreciation, and less any accumulated impairment losses.
Impairment meaning if its value has permanently dropped below its carrying amount.
Essentially, yes, if its recoverable amount is less than what it's recorded at on the books. So it's a historical cost basis, adjusted downwards for use and value drops.
But even if they use the cost model, do they escape fair value completely?
No, that's an important point. Even if a company chooses the cost model for its measurement in the main financial statements, it still has to disclose the fair value of its investment property in the notes.
So the information is still there for users, just not impacting the profit and loss directly each year like the fair value model does.
Exactly. Transparency is key.
What happens if a property's use changes? Say, a company decides to move its headquarters into a building it was previously renting out.
That's called a transfer between categories. So from investment property to owner-occupied in your example. These transfers are only made when there's a clear change in use.
Evidence is needed, not just a change in management's mind.
Correct. You need evidence like starting to occupy the property or starting development with a view to occupation. If the company was using the fair value model for that investment property, then the property's fair value at the date the use changes becomes its deemed cost for accounting under the new category, say, owner-occupied property, IAS 16.
Interesting. So the fair value gets locked in as the new starting point.
Pretty much. The accounting follows the change in the property's economic role.
Just quickly, where did IAS 40 come from? Has it been around long?
It's not ancient, but it's been around. Originally issued back in 2001, I believe. Then revised significantly in 2003 as part of a broader IASB improvements project.
And updated since.
Oh, yes. Accounting standards always evolve. Big changes came with IFRS 16 on leases in 2016, which impacted how right-of-use assets could be investment property. And IFRS 13 on fair value measurement provides the detailed guidance on how to determine fair value, which is obviously critical for the fair value model.
Shows how these standards interact, doesn't it?
Definitely. They form a whole interconnected framework.
So wrapping this up, what's the main thing you want listeners to take away about IAS 40?
I think the core message is that IAS 40 gives us a specific lens to view property held for investment returns. It focuses squarely on the purpose for holding the asset earning rent or capital gains and its ability to generate those independent cash flows.
It really separates these assets from the operational assets of a business.
Precisely. And the accounting follows from that distinction.
Right. And understanding this helps you interpret how companies are managing their property portfolios and maybe their overall financial strategy. Okay, here's a final thought for you to chew on. How might a company's choice between that fair value model and the cost model actually influence how investors perceive its performance, especially in, say, a booming or busting property market?
That's a good question. Different models tell different stories in the numbers.
Something to think about. Thanks for joining us on The Deep Dive.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.